Clint joins us today from the Nest Opportunity Fund. Clint, how are you doing?
Good, Jimmy. How are you?
Excellent. There you are. Well, the floor is yours for the next 10 minutes, and we'll try to save some time for some Q&A at the end of your pitch. Take it away, Clint. Thank you.
Great. Thanks for having me, Jimmy. And appreciate all of you spending a little bit of time. It's a tough act to follow behind the folks you just brought up. I've talked to quite a few of them and good people and very knowledgeable. But I am excited to talk to you about what we're doing here in Columbus, Ohio, and Lexington, Kentucky. And our fund's going to be a little bit different than a lot of the funds that you've seen. We are small. We act like a partnership, not a product. And we're going to be relatively conservative in almost everything that we do. So if that has of interest to you, invite you to give me 10 minutes. And Jimmy, if I take 11, I hope you won't cut me off too fast, but feel free to give me the warning or whatever it is, because that is relatively quick. So walk a little bit through what we're looking to do here. And if you've got questions, feel free to hit the chat button. And Jimmy, can you see my presentation screen?
Yes, sir. Looking good, Clint. Please continue.
Fantastic. We started this fund. Ironically, we're one of the older funds. We started the fund in 2018. The legislation was still in kind of initial forms, and we started it just simply me, my family, an operator. And although we called it a fund, we did not invest. There were some issues with multi-asset fundraising, and so we kind of built this fund like we wanted it. And as we've been investing for the past 20 years, and if you like it, great. And if not, that's okay too. We're happy to point you to some other folks that are out there doing good work as well. But what we do is we do affordable housing, heavy rehab, and we're looking at kind of urban infill area in Lexington, Kentucky, and Columbus, Ohio. We're looking to maintain kind of the character of the neighborhood. So how we do that is, it might not be the most professional way to think about it. We say if there's 38 front porches when we arrive, we want there to be 38 front porches when we leave. So we're walkable communities, and we're looking to create streets that have seen better times. We're looking to turn those around. We've been doing it so far relatively well, and we look to continue to doing that, and hope some of you folks can help us with that. Although we are small, we do have an advisory firm that kind of provides a lot of the tax knowledge to folks, and I invite you to reach out to us. Even if Nest is not a good choice for you, we can kind of help you walk through. A lot of folks are kind of an orphan in this. Maybe their CPAs brought it up with them. Maybe their financial advisor doesn't even have OZs on their platform, but we can walk them through, hey, is OZ investing even right for you? And if so, what's the right amount for you to invest in an OZ? A lot of people think through, like, I'm either going to do it, with all of my cap gain or none of my cap gain. But a lot of times the answer is somewhere in the middle, especially for some tax bracket management. And we've got some tools we can walk through you with that. And we do that gratis for folks, even if they're not investing in Nest. So as far as the Beacon Hill Nest team, you most likely would interface with me or with Meredith in our group. And then we've got our operators in there that are really the folks getting it done every day. Although we are small, we do have great audit and legal groups that are working with us. As long as they have Midwest rates, we want to have kind of the best folks on board for that. We're a little unique because we have both the OZ competency and kind of the personal financial advisory structure. So we've got those competencies, and when you call us, you won't initially get that fund pitch, but we're going to kind of walk through, what's your personal financial situation look like? Does this make sense at all? In our view, we want to have great partners come on board, but what we don't want is for folks who realize in year 5 that we're just not the greatest fit. So we'll walk you through that some. Going with the theme of our fund, our asset class is relatively conservative. So if you think about OZ funds, we all have that significant improvement or that kind of new build requirement, because we're trying to put capital in these neighborhoods. And that's going to be on the riskier side of the strategy of most real estate. So you could have bought something that's just kind of a core holding, which means it's already in good shape now, it's in a good neighborhood, it's all leased up. But that is not the OZ funds. We have those requirements. So our strategy all is going to be a little on the riskier side. And we offset that some by having kind of the most conservative real estate that we can. So COVID, I think, showed us that, in 10 years, it's tough to define exactly what office space is going to look like, or, hospitality, certainly. But what we know is that folks are going to want a place to lay their head at night, and we're looking to make good homes for good people. Sticking with that conservative theme, and by the way, you'll see our expected returns, and you'll also notice the conservative side of that as well. Our two locations are relatively conservative. Number one, because they're conservative, and number two, because they're close to where I live and to where our partners live. And real estate is a ground game, and especially, rehabbing smaller projects, you need to be there. So I need to be able to be there to do my monthly site visits and back in time for dinner with my kids. Um, Columbus and Lexington are both relatively stable workforces. For those of you who have ever seen a college football game or basketball game, you maybe you love, probably hate Ohio State and University of Kentucky. But those are both employment magnets and also a magnet to bring in, younger populations from outside of the city. And within our areas, we've got very stable employment. Even our finance in Columbus is mostly insurance. So we've got a good demographic trends, good stable base. Our population has been growing. It's projected to continue growing. And both Columbus and Lexington within the states are, the fastest growing areas. Lexington's a little bit unique in that it technically is not one of the fastest growing cities. And the reason for that is that there is an urban service boundary. So there's actually a supply constraint, and we usually don't see those in the Midwest. But effectively, if you want to draw a ring around the outer belt of Lexington, everything outside of that outer belt for 10, 15 miles is in the urban service boundary. And they do this to basically conserve that pastoral horse setting. So if you've ever driven from Louisville to Lexington or watched the Kentucky Derby, it's a beautiful drive and it's a beautiful area. And they've structured it so that there are, lots can't be subdivided under 20 acres. And they vote for that every 5 years to continue that urban service boundary. The last vote was 2018. So the next vote would have been 2023, but they also voted to not have a vote in 2023. So what we know is during the majority of the time that we're going to be investing in these urban infill areas, there will be kind of no sprawl outside the city directly. Columbus is a little bit of a more normal story for a Midwest growth city, where it's just kind of natural sprawl that's leading to pressure on the urban area. I'll slide past some of these slides. Lexington's maybe a little bit more of an unknown for a lot of you folks that aren't from the Midwest, but the area that we're in is mostly north of the downtown area. UK, it's gonna be a bit north of UK, but the area is undergoing pretty dramatic changes. Historically, the neighborhoods have been relatively rough, and now they're kind of up and coming. And there's some things that are going in that are changing the communities. And we've got some programs in place to try to share some of the benefits of increasing house prices with our tenants. But the Rupp Arena is expanding. It's 10 times the convention space is being put in. There's right now just like a little creek that runs through culverts through the downtown area, and that's going to be opened up, creating a bike trail with a splash park, and it's going to kind of tie our neighborhood in with the downtown a little bit better. Like I've mentioned a few times, real estate is a ground game, and in the smaller space, if you execute, you hit singles and doubles, and you continue doing it, and you mind your expenses, you maintain your relationships, things will work out well for you over the long term. And what we've seen is we started in really our first capital raise outside was in January of 2020, and at that time we had our partner money in, and we invest as LPs, so we try to be aligned for about a year. And at the time we had capital come in, we had 23 units, sorry. We now have 83. The graph is showing you number of properties, and it's a little bit different. So you can see that the majority of the properties that we had were started off at the inventory phase, and most all of those, except for a few that we have some permitting issues with, we've completed. And so although you don't know what we're going to buy in the future, you can kind of look to see what have we done, how has it worked, our underwriting techniques to get an idea of what it's going to look like in the future. So although we're buying properties for little houses for 40 grand, let's say, and we put 100 grand into them, now we're buying them for 45 and putting 105 into them. You can get an idea. It's going to look pretty much the same. So looking through, somebody mentioned in the opening, what's going on with construction costs and how does that impact the 30 months time frame. It doesn't really for us. We're still looking like, can we underwrite, new property purchases? And as long as we can, we'll continue doing it. So the properties that we have completed, 14, 8 of those have been appraised for financing. And we see we've got values that's 23% above our total costs for those properties, which is above our kind of projected assumption, 15%. So even though construction costs have gone up, we still see that it's making sense for our investors. Speaking of the underwriting, it's always easy when property and construction prices are increasing to continue doing it. But we underwrite when we buy a property, we want to have a 15% annualized rate of return, and we want it to cash flow at 70% leverage. So I believe that bad things happen when you don't have cash flow. So we always want that cash flow as well. I've got a couple of examples of just a sample property to give folks an idea. In a single family, we've got some multifamily too, just have a 32 unit we're working on right now. But the single family is a little bit different and not stuff many people have in an institutional form like us. Our fund structure is, we're set up to have our OZ fund, and then we've got subsidiaries underneath the OZ fund. We had a Series A capital raise that we closed earlier this year, and the properties and assets within that Series A, in order to the benefit of the Series A investors. And then in the spring of this year, we plopped some money into a Series B, which are new subsidiaries, and we're now capital raising for those Series B investors and for those properties. We've closed on 2 properties, relatively small properties. We're really excited about them though. In particular, one of them is just one of our techniques we like to use a lot, where Series A already owns kind of one of the 2 dilapidated properties on the street that's really improved, and Series B was able to buy the second property before we even started on the A. So we get to buy at the price of a street that has some blight on it, but we know that our 2 properties will become the nicest 2 on the street by the time we've completed them. So we are buy and hold. So we'll buy those properties and we will hold them. And we do some impact things with giving folks kind of the opportunity to get some down payment assistance to buy our houses if they've been with us for a while, to kind of share the benefits of the OZ space and improving properties. In addition, in Columbus, and we've got a flyer on that we'll be happy to send to you, our operations here for our construction workers. We really focus on folks who have graduated through addiction programs. And I was a little leery on the business case for that originally, but our operator has a real passion for it. And frankly, in a year like COVID, where it was really hard to maintain construction crews and employees, we saw that our turnover was very low. We had essentially no issues. Just a little bit of information about kind of the financial structure of our fund. Like everything about our fund is we're going to be pretty conservative and simple. So our fee structure and our waterfall is relatively simple. We think it's aligned, we think it's fair. And in particular, when you look at the fine print, we don't have our LPs don't pay our marketing expenses. There's no overhead allotment. So our stated fees are going to be our stated fees and the costs that you have. We've raised $5 million to date, and that's not a big number. And I actually bring that up to show you that we are small. So we are going to be you should think of us more as a partnership and less of a product. And if that's something you want, that's awesome. We want to talk to you. And if that's something you don't want, that's okay too. We're happy to link you up with other folks. We're pretty connected in the OZ space. And I can see Jimmy's on board now, so I'm probably getting the hook. But feel free to reach out to us, even if you don't like our fund. If you have questions on, hey, is OZ investing even right for me? We've got a lot of resources in the personalized calculators we'll have to share with you. Thank you, everyone.
Excellent. Well, thank you, Clint. We've got time for one question from Stephen. Will these assets be a 10-year hold, or will you turn the portfolio within the fund?
Yeah. So our plan, Stephen, is to hold all of our investments for 10 years. Now, there might be some opportunistic issues. We buy a lot of properties in packages, and perhaps one would not fit with it. But the idea is to hold them for the long term. Another thing that might make that a little bit different is for property of our packages, we've kind of got a pilot program where we are providing down payment assistance. So for every year they rent from us, they get 1% that goes towards the purchase of the property. We don't let them do it for the first 5 years. And the idea of that is, in my mind, one of the impediments to the middle class is homeownership. And one of the impediments to homeownership is that down payment. If you work at Walmart for $15 an hour, it's really tough to scratch up that down payment. So that helps with that. We've also partnered with the city of Lexington to give us some grants with that. And so those could be sold, sooner as well. We'll see though.
Excellent. Well, Clint, time's up, but great pitch as always. Thank you again for joining. Second time in a row now, having you on OZ Pitch Day. Really appreciate your time and attention, and we'll be in touch soon.
My pleasure. Thanks for
Thanks a
having
lot,
me. And
Clint.
I'll be here for the happy hour as well if anyone has any other questions.
Fantastic. Yeah, we got a happy hour coming up at 4:45 p.m. Eastern time. Thanks for bringing that up. We'll
I don't
provide.
miss it. I don't miss those.
Yeah. Yeah, absolutely. Well, we'll hope to see you there. Thank you, Clint.